Hello and welcome to this DerivSource Industry Insights video. I'm Julia SCHIEFFER, the founder and editor of DerivSource.com. Collateral managers will continue to be under pressure in 2019 as they work to meet regulatory obligations, but also look to invest strategically in their operations to improve efficiency and automation where possible. And with me today to talk about the challenges that they face and the various market solutions available to them is Helen Nicol, Global Product Director, Collateral Solutions at Vermeg. Thank you for joining us today in this video.
Thank you, Julia. Happy to be here.
So let's start by looking at the regulatory rules that firms are dealing with now. Can you outline kind of the priority regulations firms are focused on?
Sure. Well, as you quite rightly say, regulation continues to challenge all organisations and drive change across all regions. We've seen, obviously, the first phases of the Dodd-Frank and IOSCO EMIR regulations. We've had MiFID II, we've had the SFTR. Next year we have the FINRA 4210, and we're seeing the next phases for the uncleared OTC initial margin requirements for September 2019 and September 2020. For the uncleared OTC, the phased approach obviously continues, and according to data gathered by ISDA, this could potentially see an additional 1,000 counterparties impacted and 9,000 new trading relationships come into scope.
So a very, very big deal for the industry.
Potentially. Having just come back from the US, however, it seems that the CFTC is currently seeking comments on proposed amendments to these rules, and many buy-side organisations are currently waiting to see whether they will actually be impacted by the initial margin requirements or whether the thresholds and notional obligations change. On the cleared side, the deadlines are also coming into place for mandated clearing for both the interest rate swaps and the CDSs. And we are actually seeing a move towards some buy-side organisations choosing to opt in earlier than the proposed timeframes, just in order to get their own internal structures and processes in line. Finally, the questions around Brexit for the UK obviously have an impact from a regulatory perspective. A hard Brexit would mean no retention to open access on the single markets, and crucially, no guarantee of the EU passport for UK domiciled banks. So there's quite a lot that's going to come into play over the next 12 to 18 months. And I think the one thing that all organisations are still looking at is the time to market in terms of meeting those deadlines.
So some knowns and some unknowns
Absolutely.
Coming up for 2019.
Absolutely. I think preparation is the key.
So Helen, you mentioned mandated clearing. Talk to me a little bit about that, because I know that the buy side hasn't traditionally exchanged initial margin, so it is a bit of a change for them. How are you seeing them prepare? Well,
obviously mandated clearing began in 2016 for the sell side, and we've seen that roll out different levels of success. The CCPs set the initial margin to reflect their estimate of the riskiness of the underlying transactions. For the buy side, I think often the challenge is that they don't have direct access to the clearing houses, although organisations such as LCH and Eurex are trying to offer that. This therefore means that the buy side need to engage with several of the dealers. Even when there is direct clearing available, quite often the buy side don't have the infrastructure required to provide the connectivity to those CCPs. They don't have the APIs, they don't have the large technology teams. So, quite often they will be reliant on engaging a dealer to provide those clearing services for them. What we're also seeing is several of those dealers don't want to offer the service to the very small clients, so those with 10, 20, 50 trades. It's simply not cost effective for them.
So sticking with mandated clearing a little bit longer, what are some of the market solutions out there that you think can really help these smaller firms from an operational preparedness perspective?
Well, as we've already mentioned, several of the larger dealers have decided to move out of offering client clearing solutions for the very small clients where there's 10, 20, 50 trades. It's simply not cost effective for them. But there are now some new participants coming into the marketplace that are offering hosted solutions for client clearing, therefore removing the infrastructure obligations and making it more cost effective for them. They are gradually starting to roll out across existing and additional CCPs on a global basis and across multiple different products. And we're seeing an uptake in this from the buy-side market where perhaps they don't have a requirement or an obligation for uncleared OTC, but they do fall under the mandate for the cleared regulations.
So my final question for you is, looking ahead to 2019 and beyond, and looking at the bigger institutions, what do you think those banks or the large asset managers, for instance, should be focusing on going forward for this space?
Regardless of whether an organisation is large or small, automation and increased levels of STP are vital as the volumes and the levels of complexity increase across all asset classes. Often antiquated infrastructure remains within the firm and acts as a hindrance to achieving the required levels of automation. And therefore this creates an additional burden on potentially already overloaded resource. We're seeing teams look for integrated inventory solutions across all regions so that they at all times know where assets are located. Again, whether they sit in segregated accounts with custodians, tripartite agents or internal structures. Once firms have access to their inventory and realise where the assets are sitting and how easily they can be moved across regions and jurisdictions, then they have the ability to look at the optimisation from a cost perspective and also quite often, particularly with the buy side, more a client strategy or counterparty or fund strategy perspective. Therefore, access to robust technology is crucial, and we are seeing a number of organisations that traditionally perhaps have built in-house now look to take modular provision from some solution providers, whether that's a vendor or an outsourcing platform, in order to, I guess, boost their own internal piece. So they may not take a whole solution, but they will take pieces of it as they're recognising that the support and maintenance of these platforms can be quite substantial.
So sticking with automation a little bit longer, what does that mean to different firms? I mean, is it just getting rid of manual processes simply these days?
For some it is. Certainly the smaller organisations, they're more concerned about the issuance of the actual margin calls, the booking and settlement processes. For others it means things like increased levels of APIs, perhaps hosted solutions. Distributed ledger or blockchain has been a hot topic for some time. Now we're seeing a move to AI, and certainly some of the larger organisations are looking at the asset selection based on the AI functionality. So it really depends on the size of the organisation. We've also seen a big increase in requirements for microservices, where areas within large organisations need access to data held by collateral systems but don't necessarily need access to the collateral piece themselves. So legal documentation, reporting, the transaction reporting, the securities and pricing, access to all that data is becoming fundamental to everybody.
So in your mind, 2019 is really going to be more progress, more focus on strategic investment for collateral managers across the board?
I think it has to be. If we're going to keep up with the market and the regulatory requirements, then we have to look to this as a long-term strategy.
Okay. Great. Thank you very much for joining us and sharing your insight with us today.
My pleasure, Julia. Thank you very much for having me.
Thank you for watching this video. To find out more information on this topic or related topics, please go to DerivSource.com to read our articles, listen to our podcasts, or sign up for our various webinars. You can also subscribe to our YouTube channel or follow us on social media. Thank you again.